the market this week was really came in on a really shaky note. We opened up on the futures in the morning on Monday, basically lock limit down over 1,000 points, and immediately dropped another 40 or so, and since then reversed fairly strongly. The next day had opened up big up, but then finished down, and then the 3 days after that, we've been, for the most part, in a more of an up market, except today was a little bit more consolidation. So the volatility that happened last week, which kind of culminated in Monday morning's move, the question I think most people are asking now is, have we seen the worst of it, or is this the start of something a lot larger? And I think the answer to that is not yet certain. I wish I could say yes, we're through all of it, or I could say no, we're definitely going a hell of a lot lower. The market, is going to fall apart and this and that. But we have to see what happened here was fairly classic. We've been for the whole year, and I've said this for a while, that I haven't been a big fan of the market. I thought we were in a pretty large consolidation range, and I haven't liked the the odds of how things are playing out, just because things have just been choppy in a range. And balance usually leads to excess, and I guess you can characterize what happened last week and into this week as a very large liquidation break, exceptionally large. It was very flash crash-like. I don't know how many of you guys and girls have been trading since, this happened. The flash crash, I believe, was 2010 already. I can't believe how long ago it is. Seems like just yesterday, or Monday. So what usually happens is we've broken some supports, some major supports. I had been talking about some pretty big levels, and I'm going to just tick them off quickly for you. We had some reference lows in the market in the 204s in SPY. I also had discussed 201.92 being an old reference high, and also the gap fill of sort of the move that has consolidated. We took out the lows in the 197s. And we even got all the way down to fill the gap at 190.30 and got down to 182s. Holy crud. I had said that I thought that the Fed day was going to be the key range for the rest of the summer and maybe the rest of the year, and that above it was long and below it was short, and man, did we never look back. If you take a look at the Fed day high, it got the 210s. Which have been a really critical sort of pass, don't pass line. And I guess when the market saw that we couldn't go through it, it was just selling. Because when a market can't go higher, price has to go lower. You could have semantics that it can go sideways and such, but when markets in general, or stocks in general, can't go any higher, they go lower. And I always say that people who are in the large positions sort of manipulate the stocks to the highest point where their buying can no longer raise the price. And once that happens, they start selling rallies on the way down, or in this case, just all at once. I think that has a lot to do with the markets, the dynamics of the markets, and how things have changed with technology over the last few years. The firms don't really scale positions anymore. They just dump, or they just buy. It's sort of just sort of how it is. Anyhow, the key levels that we need to see if we can kind of recapture to kind of repair the market are as follows. And I will say this: the best thing right now that the market has going for it is that this is really considered, if this is kind of the big one, this is only leg one. So usually leg one is sort of not the real dangerous one. It's sort of the shot across the bow, so to speak, because usually after a leg one down, there's a counter rally back up, and that usually gives people an opportunity to get out with still some of their profits. And if they were, if they were nimble enough, they could have bought some of the lows and then sell out on the rally. Now, like I said, the best thing the bulls have going for them is that the market has done this really sharp, really fast, and if they can recapture the key levels that I'm about to lay out quickly, then I would say it's sort of no harm, no foul. If they're not able to recapture it, meaning we go back up and retest and then fail, then I would say the market is going to be looking a lot more ugly, and things can get pretty violent pretty quickly again. So these are the levels. Anyway, we recaptured let's say a 50% move of the market, which was the 197.86. We closed back above that yesterday and today. Okay, good. We are back into the lower end of the range. That takes a little bit of the risk off the table. The bad news is that we are still below, and if you look back at some of my videos, I had said that I thought that the 201.90 would kind of do it. That would be the right or right out place for either a long, or if it broke to flip short. I had been playing this with some put ratios, and they got pretty badly blown through. I had to be a little bit nimble on getting myself out of them. They wound up being a little bit of a loss, but nothing too terrible. But the fact that we blew through that channel, that has been the channel low since the 2011 debt ceiling debacle low. And it's been a long-term uptrend, and we broke through that very badly on Friday, and then Monday, I guess, was the logical follow-through. So usually, like I said, after the breakdown, there's a retest, and I could see a retest coming all the way up to where we got through one of the retest points at 197.86. The next major retest point here is going to be the 201.79, which is the 61.8. So let's just say roughly 201.90s to 201.70s to 201.90s, which was the level I had discussed being the key hold. If we keep going from there, I would say the 204s would be the sort of the final area. I don't know if we're going to get back through there. Roughly around the 204s, close to 204, 205, is where the real supply starts coming in, where we've traded for the most part for the most of the year. And I think all of those people who are now wrong will be looking to get their money back. So I do think that at some point we are going to have an opportunity for, at the very least, a right or right out short for a day trade at the very least. So I sort of have my alerts set up around the 204, 205 area. So that would be a great place to go in size for right or right out short. If it is right and the market rolls over, that could be an amazing runner for maybe even for years, believe it or not. If that's the rollover and we are technically going to enter a bear market. You know, bear markets can take 18 months to 2 years to resolve. And think about it, you'd have trade locations still from the almost basically at the all-time highs. So, you know, if the market is trading 150 or 160 in, 10 months from now, and you're still short from 204s, sitting kind of pretty. Anyway, I don't want to get anyone too excited with that scenario yet. It is also possible that the market, like I said, this was just a giant liquidation break, and setting up still, believe it or not, for the blow-off top. I know that seems absolutely absurd here, but believe it or not, that kind of volatility could happen. We could see something really, really violent to the upside, and we could see, something insane that nobody has ever seen before. So just stay nimble. I just use the levels. I don't like to sort of think too far ahead. I was talking about some multiple time frames there, and I was talking about, some of the things that could happen, but we don't know that anything is going to happen just yet. I can tell you this, though. The longer we are below that 204, 205 level, the more dangerous it is for the bulls, because you're starting to build some volume lower, prices accepting lower. If it immediately rejects, that's a better case scenario for the bulls. So what am I thinking? Where is my bias at? So I'm thinking this. I'm kind of putting my institutional hat on for a moment, and if I'm a money manager or if I'm a risk management desk, you have to start thinking that people are going to start taking down their VAR, which just stands for value at risk, meaning they're going to tighten up their positions, and that is basically requiring selling, and they'll probably do that into some strength. This should be no surprise to people who have been following me. I've been talking about the MOC which is the market on close imbalance, just the amount of institutional orders to buy the market on the close or to sell the market on the close, has been to the sell side with a bias for months and months. And it is culminated in this sort of free fall at the end here. So we're going to be looking for that early this week to see if we accept price above, or if we get back, or if we're going to go below. I would say that the points here to be short would be is if we break back below the 197.86 here, like if this is sort of all she's got in this rally, it can be a short immediately. If we do continue to rally, what would be amazing if it's on gap form and gap fashion, I would be looking to sell or do some trying up in the 204s to 205 region. I think that's going to be a really hard area for the tape to get through, and it's right or right out. Maybe just risk a buck. That's it. So that covers my I guess my analysis on SPY. I'm going to cover a lot more of that in my weekend review video, which will be out on Sunday. Also, if you're first coming in now on the video, this will be on my YouTube channel. You could replay it. That's at Justin Pulitzer Trades. There's a link to that in my Twitter account, which is at Justin Pulitzer. You could follow me on there, and then click on the link in my profile to see my YouTube channel. I highly suggest subscribing. By the way, I do reposts of these Periscope videos. I do a special weekend review video, which is only on there, and I also do some special edition videos that I think are very useful. There's going to be a bunch more of those coming very soon, by the way. Anyhow, back into our analysis. If you remember what I talked about with VIX, I had been saying that we had been making lower lows and lower highs, but I was a little bit concerned that we sort of had a bit of an excess low here, and we got into the 10s, 1088. And since then, the VIX has really never looked back, and it has done something that is really, really dangerous. I always talk about sort of a normalized market VIX range, and 10 to, or I guess it's been 11, but let's just say 10 to 13 being sort of the lower end to range. 14 to like 17-ish being sort of the middle to upper end of the range, 17 to 20 being kind of the upper end of the range, and then 21 to 25 kind of being the sort of the capitulation area of the range, and sort of where you need to start thinking about reversing positions. I also always couch and caveat that with anything over 25 puts crash risk on the table. And that is why what happened on Monday happened. Friday, the VIX actually closed at 28, which is above that area, and that's why we got the acceleration to 54. So what happens when the VIX accelerates that high? It starts changing things, and it starts changing the mindset and the dynamic of the market. Yesterday's VIX got slightly below the last high, which was 25.20, but it held at the low of 24.49. And then today, we still closed above 25. So that does not take crash risk off the table yet. Believe it or not, I'm not saying this happens, but you can open up on Monday down 1,000 points again, believe it or not, still with this elevated VIX. I don't know that that's going to happen. It doesn't. I would probably, if I sort of had to pick right here, I would say that that's less likely than likely, but it is very possible given the VIX environment. So how do you handle an increase in volatility? How do you trade in a new world, right? A higher volatility world with VIX? And the answer to that is that you kind of have to play the premium game. And that's when the VIX gets really high. You have to be a net seller of premium, or at the very least in playing directionally with spreads, because you're introducing a new Greek into your calculations. Now, I had kind of hinted that I was going to talk about the Greeks, and I'm kind of backdooring my way into it with regard to with regard to VIX. And when I talk about Greeks, I'm not talking about Greece. I'm talking about the calculations that go into the Black-Scholes options pricing model to calculate the value of puts and calls. Now, if you're on the Ameritrade, the TOS platform, I'm going to just go through this kind of as a quick and dirty explanation of this. And I want you to start thinking about this. When you're playing options, do you think like this? Is this your mindset? Do you even know what these components are? And I know that there are a few of you who are following me who are a little bit more advanced, and some of you who are, I guess, a little bit more beginner stage. And if you really don't understand this stuff, you probably, and I don't mean to scold you, but probably don't have much business trading options. You probably shouldn't be thinking about options than more than just, maybe some covered call strategies or, some longer dated call spreads or what have you. But yeah, kind of have to know when to play them. And I'm going to go through the Greeks here and explain to you when they become more important. The first is your delta. I'm going to just list them off and then we'll go through them. There's delta, gamma, theta, vega, and then rho. Rho I'm not really going to focus on in this video because I don't see it in the platform, and rho also has more to do with interest rates. We've been living in a ZIRP environment, so it hasn't been that important, but let's go and talk about delta. The delta in options, and let's say we're looking at SPY. Let's look at the September 21 days to expiration. If you take a look at the SPY, let's just do the at the monies. Let's just say the 199 puts. They are trading with a delta of 48, minus 0.48. So what does that mean? That means for every dollar 1 point move in SPY that moves up or down, that will be the percentage of, or the dollar amount that those options change. Moving along. So that means, like, let's say you bought the 199s. That's what you would be expecting to catch of the move, the 48 cents. So it's not 1 for 1. When you start moving into the money, like let's say you moved into the money with the puts all the way, it would take you quite a ways to even get there. Even the 210s are trading at 84 cents. So anyway, what most of you always trade in weekly options. I always discourage buying weekly options, but I know you guys don't always listen. So I prefer to be a seller of weekly options, but if you are involved in weekly options, you have a lot of what's known as gamma risk. And the gamma is the first derivative of delta. And that just means the amount that the delta changes per point. So let's go to our 199 strike example, and that would mean for, this is in the 21 days to expiration, still in September, the gamma there is 3 cents. So for every dollar move up or down, I know we closed at 129.24 here, so let's say we go down a buck, that delta should increase by 3 cents. So you'd be at 51 for the move down. Gamma becomes really, really important in weekly options because as the stock moves around a lot, that gamma becomes more and more important. Just remember that. So you have a lot of gamma risk if you're involved in weekly options. The next and for the most important part, I would say in the weekly, I'm showing you in the monthly, but I'm talking more in general here, and this comes into play in the monthly options and the weekly options, and this is why I always say I prefer to sell weekly options, because options are made up of two components. Besides these, just it has to do with the intrinsic value. I don't want to get too wonky and get into that. It just has to do with the the actual dollar amount of the value of the options, plus the time value for the options, for the amount of time that the option is alive for. And that theta decay or theta burn, you'll often hear me talk about theta burn, that is real. You will automatically every day that the stock trades or those options trade, they lose that amount of money. That's sort of like your rent that you're paying to be in the trade, and in this instance, it's 11 cents a day. So those options here, theoretically, the mark was they should be trading at $4.52. If the market opened on Monday and didn't go anywhere, and we just sat flat, those options would be $4.41 by the close. You would have lost 11 cents just for playing. Thanks for showing up. That is why whenever I like to play options, and that theta decay, by the way, becomes exponentially quicker when you're involved in a weekly option. Like, let's say an option's $1, and you're losing 10 cents you're losing, let's say, 10 cents a day. You're losing 10% of the value. And that will become, like, let's say the next day, as your amount of days to expiration expire, it could become 15 or 20 or even 30 cents. And you're losing huge chunks of the premium. This is why I don't buy those options. If I am playing in the weeklies, long options, and it's very rare, I would do it with spreads. If you're short options, those decay also, and that offsets your rent payment, your theta decay. It's sort of like Airbnb-ing your options position. You limit your upside because you're capped off, if you're doing a call spread, but you're also not going to miss your rent payment because you have a tenant, so to speak. That's how I think about it. And looking for you kind of know based on the expected move what options can do. In a high VIX environment, options can do quite a bit. And I would say if you're going to be doing, I don't like to do really the ratios as much in this environment, although I've been doing some. You really want to widen out your strikes. I always talk about, like with Apple, for example, I like to do $3 in between. So, like, let's say I was doing, like last week, actually, coming into Monday, I had on a 109, 105 call spread, and that got blown through immediately. I mean, this Apple went down to 92, so I was pretty heavily underwater for a little while by one of the options, but I was able to finagle my way out of it on the way up, and I wound up actually taking it off, I believe, for break even. A couple of these I took off for some profits, some of them for some minor scratch losses, but most of them for break even, except for the SPY one. That one was a little bit of a larger loss, but it really wasn't that big of a deal. Anyway, I believe that so let's say, for example, in a normal environment, a normal VIX environment, I'm doing the 1x2. I'm long one of the 109s and I'm short two of the 105s. In a normal environment, I know that Apple probably won't be more than the $3, and if it is, I have extra room to the downside because put ratios obviously have lower break-evens. In a high VIX environment, those strikes can be blown through like we just discussed. So instead of a $3 spread, I'm looking at maybe $6 spreads. Like now I'm talking about maybe doing, I think I have on, Apple has rallied since I had put these on, but I had done, like, let's say 194s. That's a nice $6 chunky spread. I'll probably be looking to do some more of these next week because Apple reports they're launching their new iPhone. I believe that's on the 7th. So I'll be looking to do something into that event to take advantage of. I think that's actually the week after, right? It's the not next week, is it? But the following week. I have to do a little calendar work on that just to make sure. I'll talk about it in the weekend video. But I'll be looking to do something now. Apple's up to 113. I'll be looking to do some of those types of put ratios for kind of like a sell the news type of event if Apple is going to pull back. So with regard to Apple is currently above the downtrend line it had been placed in since its earnings gap. You had this move down to 92. I've been saying for a while I thought that, that 100.72 was the old high, that I thought we would see that. I thought it was also possible, I said if the market that was also trend, by the way, And I had said that I think that if the market got really squirrely, we could see 95s and potentially 85s, which are 50% and 61.8% fibs of the entire moves. We got pretty close. We saw some of it. Apple has now rallied back up. It is sitting right above the downtrend line. It closed above it yesterday. It's sitting above it today, and it's stopped and is holding right below the 20-day moving average, a downward sloping 20-day moving average. So for me, the levels here that would be really key is for Apple to still hold the 109, 110 area. If you lose that, I think that it's going to be safe to say that Apple will probably go back down a lot. I'll talk about where I think that could go in the weekend video, but I would say that it could be even $10 lower, down to the 103s and maybe even to the 100s. That area, there's a lot of reference areas in that area. There's a lot of reference support. You can see even the day after, like Tuesday, the pullback low was into the 103s that held. That's not by coincidence. These levels are key reference levels. I think that if Apple wants to rally, it can probably get up to the 115s and maybe the 119s to 120 max, if there is some good stuff that Tim Cook talks about, or if people want to get excited about Apple. The expected move for next week is just under $5 at this point. It's $4.81. So factor that into your equation here. That would take you into like the 117s or so. It could potentially blow through to the 119s. I think up there would be a good right or right out type of a short play, but I would say that Apple probably should be stronger for the fourth quarter. Longer term, I'm bullish. This again is going to depend on the market. If the market rolls over, these stocks are all going to get killed again. All of this analysis right now is all things being equal, assuming a benign market. There's a component of all stocks that has to do with the direction of the broad market. And if the NASDAQ is getting smashed, so is Apple, frankly, or vice versa. If Apple's getting smashed, so will the NASDAQ. They sort of are synonymous at this point. They are such large percentages. So that covers Apple. I covered the VIX. Let's talk about the lower for longer thesis here. This is really, really important, and I think that a lot of people had poo-pooed this, and it is now coming back to bite them in the you-know-what. So it's been consensus for a while that the Fed was going to raise interest rates in September. It was sort of almost a fait accompli. I had said that I did not believe that. I believe that the growth is slowing globally, and that has been evident for quite some time with crashing commodity prices. You could take a look at it. You pick it. You name it. Oil, copper, gold, anything that is a symbol. I wouldn't say gold is a symbol of world growth, but it is a sign of inflation. And I have been saying that the problem has been deflation, and that there's a lot of overseas risks, and our growth rate here has been rather anemic. The first quarter had been recorded as negative. It was since revised up to like 0.6, and then they revised down the prior 3 years worth of GDP, which is pretty enormous. I had actually written an article about this, and I'll post this as a link in the rebroadcast of this on YouTube. So if you're watching this on YouTube, just click down and look in the description and click on that link, one of those article links, and read it. I think you'll find it interesting. Anyway, I had said that the key level here was to hold the 123s, and then I thought we could see the 127s. And that is actually what happened. We got up even higher than that. We got up to the 128.92, but after that we have subsequently reversed, and we are now closing below the 123.15. That to me, this can be a little bit squirrely. There's it often will close above or below a level for a day or two and then kind of retrace it. So for the most part, we're kind of hanging around where it needs to hang around, slightly below it. I think that has to do with the fact that China has been maybe selling some of our bonds. They are going through a 1929 type of scenario currently. Their market had a blow-off. It became a big casino, and they are paying the price for it. their government is using a lot of money to prop up their stock market. I think they're also going to have to start implementing some changes with regard to their growth outlook and for the prospects of their economy, and maybe they're selling some U.S. bonds. Maybe also we got into some reference areas. The technicals always seem to line up with these things. We got very close to a 61.8 Fibonacci retracement there, which would have been 129.48. We got within like a buck. So I would say that's kind of quote unquote close enough for government work, and we have pulled back. You now need to see the if we're going to be below 123, the keys there to hold are 120.57-ish, and then there's potential even down to the 117. So if you're bearish on bonds, and I'm not saying that they are all outright bearish here, but if you want to play for a move back into those range, I've said that the 17s are a key pivot. Maybe do a put ratio, a weekly or something like that for a move back down. I do believe that rates are just going to be in a pinging range, and that what amazes me is that on Monday it was sort of starting to become consensus that that we were in the lower for longer scenario. And if you're new to me and you're new for my thesis, that just means that the Fed is going to have to keep interest rates lower for an extended period of time. And we already know through the Fed staff leaked documents that they are going to normalize at a lower rate, about I think it was a little bit below 3.5%, but which was actually my target, which I've discussed. So that seems to be spot on, and that wasn't going to be until like 2018 or 2019. I don't know why, but the media seems to be obsessed with pushing for this, one and done, and what's the big deal? It's just a quarter of a point, and we need to normalize. The big deal is that the Fed has been under a zero interest rate policy and in a policy of accommodation and easing for quite some time. And even with all of that, the growth in this country is really slow. I do realize, and I am cognizant of the fact that the GDP for the second quarter was revised up fairly significantly. It was revised up from 2.3% to 3.7%. That's a pretty big revision up, and that, I think, would normally take the chance of recession here, which I've been saying is a big risk, off the table. The only problem with saying that, though, would be to forget that the first quarter of GDP was 0.6, and that's after the revision up. And I think a lot of the revision up in the second quarter GDP is a lot of stuff that was sort of pushed back, purchases that should have been in the first quarter that happened in the second quarter because of better weather or maybe a perception of better financial conditions. Don't forget, during that quarter, Asia was booming, right? We were up making record highs in China. That is now completely reversed. And China and Japan and these other economies are collapsing. They're devaluing their currencies at an amazingly, it's like sort of like a race to zero, how fast they can lower their currencies. Of course, this is because they're export economies and they want to make their goods cheaper for foreign markets, like in the U.S. or in Europe. So I think that a lot of the strength in the GDP number in the second quarter is sort of catch up from the weakness that was experienced in the first quarter. Anyhow, I don't want to get too ahead of ourselves with that, but I don't know that the Fed should hang their hat on that because we now have the sort of the Asia crisis. Global growth is seriously slowing, and it is only a matter of time. If it hasn't affected the U.S. yet, it already will. I anecdotally have been going around. I've been talking to some Main Street people, and they've all been asking me all week, what's going on? There's a crash going on Wall Street. This doesn't give people a lot of confidence to go out and buy a new car or to go out and count on spending their holiday bonuses that could be curtailed, particularly if they work on Wall Street or in financial services, or to buy apartments. Anecdotally, I heard a story this week that somebody who was involved in a real estate deal got pretty badly banged up in the market, and they were maybe delaying their purchase of an apartment. I mean, this stuff has ripple effects. The Fed has wanted to create this wealth effect for a while, for years. They've pumped liquidity into the system, and that money has not been used by companies to grow their businesses or invest in capital expenditures. It has been used to pay out dividends and to buy back stock. And that is because there's a lot of uncertainty still in the market. And all of this back and forth between this Fed guy is like Dudley spoke yesterday. He was fairly dovish. I heard Stanley Fischer today. I thought he sounded fairly dovish, although the market seemed to think he sounded hawkish. Although it seems like the general consensus has been fairly wrong on the Fed for a while. They haven't really gotten it right. The dollar gunned up on his. It's been rallying the last couple of days as fear rises, and as people get worried, the dollar it's a kind of a flight to quality or a flight to safety. What really happened, in my opinion, with the dollar here is that it's been in a down channel. It sort of formed a bit of a head and shoulders. It absolutely collapsed last week, and this week it's just sort of checking back to the neckline of that breakdown. There are major moving averages there: the 50, the 100, the 20. They're just, you name it, the 150. They're all jumbled up there. So these 96s here are going to be really key. If we bust through that, let's say the full-on 96, through the 96s, we could potentially see the channel high again, which is up closer to 98s, 97s, 98s. And I would say that if we can get up that high again and sort of negate this head and shoulders top here and clear the 98s, we are in deep, deep trouble because we could see the 100 very quickly, and then there are some Fibonacci extensions I can talk about after that. That, to me, would be the nightmare scenario for the stock market, because international companies like the Nikes, the Facebooks, the Apples, all rely on a lot of sales overseas, and their earnings estimates will have to be lowered with a stronger dollar. Keep that in mind. It's all about the expectations of future growth and earnings estimates, and if they start getting lowered, it's big, big trouble for the S&P 500 with a lot of these more local sort of companies that do domestic. That aren't only domestic, that are international. Anyway, I don't want to get too wonky and focus on all of this for a while, but these are some big risks that we have to look out for. Early next week, we want to see if this dollar strength lasts or if it rolls over. If it keeps on going, you're going to see some trouble. We've been talking about oil. That has had a pretty sharp rebound off the lows here. I had been talking about 37s and 30, between 33.20 and 37 being probably a area that would be a low. We bottomed here at 37.75 and rallied even in the face of a strong dollar, which is strange, right? Maybe we finally have reached the breaking point, or I should say the area for oil where it's bottomed out. You've seen a lot of reversals in a lot of stocks, and I'd say that there is some room still, believe it or not, in oil to rally. Between 48 and 50 starts becoming some more resistance. We'll discuss that, and I'll show that in my weekend review video a little bit about how that could be some trouble. Some of the bigger stocks I had talked about, ExxonMobil, for example, made a pretty key low. If you take a look at where it bottomed out this week on sort of the flash crash, it got down to the 78.6% Fibonacci retracement. It now bounced up. I think it found a little bit of resistance today on the 20. We have to see what you really want to see with all these stocks is if they pull back into a higher low and then can take out the previous swing high to change the pattern. You want to start seeing higher lows and then higher highs. And then I would say that these start becoming more safe to buy. A lot of these energy companies are fairly heavily debt-laden, or they don't have enough cash to cover dividends and service debt, or to handle their buybacks. Like Chevron, for example, canceled its buyback but is committed to its dividend. Exxon partially canceled the buyback. They cut the buyback and they kept the dividend. I don't think that that company really has much of a chance of cutting their dividend. I mean, you'd have to really see oil down in the 20s to even be having that conversation. So let's couch that for now. I am looking to see if there is some type of a pullback, if it can be to if there is to a higher low. That's what I'm thinking with regard to oil. and the oil stocks, I should say. Some of the other names, someone asked me about Twitter. I've been getting a lot of questions about that, and a few people on the stream have asked me if it's a takeover. The answer is it could be. It's still an expensive company. I think I have to check and see what the full market cap is here. I haven't looked in the last couple days. I think it's something like 10 or 12 billion bucks or whatever. It might even be more. It might even be, I think it could be in the 20s. I have to check. But regardless, Twitter is really still not cheap, believe it or not. For a takeover, it would take a lot of money, a lot of balance sheet cash, or to take on debt for a company to buy Twitter. It's possible that they could be bought, but as 18 billion, there you go, thank you. So Twitter could still be cut in half again and still be expensive, as crazy as that sounds. I don't necessarily know that it's going to be a takeover. They have been executing rather poorly. Their management is proving to be quite incompetent, actually. They have mismanaged this very badly. Their user growth is nothing. They have no growth in users. Every company that has a valuation like this that trades at multiples times earnings, in the tens of multiples times earnings, has to have the expectation of future growth. Twitter is stalled out here. They are actually almost contracting. So the question is why will Google pay $18 billion to buy Twitter? Yeah, they're monetizing well, but they're not growing users. You have to have some growth, or they'll buy it cheaper. Like if Twitter was $9, for example, maybe someone would be interested in buying Twitter, and then paying, maybe they'll pay what it's trading for now. The expectation of someone buying Twitter, they're not paying $18 billion here. They're going to want to sell this for some type of a premium, maybe in the high 40s, mid 40s, or 50s, right? So people would be, how many people are going to be paying, $30 billion or 40 or whatever for this company? I just don't see that happening so easily. So I sort of believe that they need to kind of fix their problem. They need to, generate user growth. They need to change their product. These aren't processes that happen in like one quarter. But I do believe that they need to do something to arrest the decline in the stock. Guys like Elon Musk are very good at coming in and buying shares. It would help if Twitter's management would stop selling their shares and actually start maybe buying some. So that's my feeling with Twitter. As amazing as it sounds, I still prefer Facebook in terms of their growth prospects and their revenue streams. It's just a better company. It's better managed. It's a better product in every sense of the word. They have multiple revenue streams. They have Instagram, which is growing like a weed. They're going to start monetizing that now and making some money. They have the mobile payments. What is Twitter doing? They just made it so you can't, so you don't have a 140 character limit in direct messages. What the hell are these guys doing over there? They should be doing the same thing. They should be doing some mobile payments. They should become more Instagram-like with better photo apps and availabilities. I know they've been trying to do some stuff like that, but they haven't been really succeeding. The one thing I think Twitter could really do is get more sports involved. They made a deal with the NFL. Let's get FIFA. Let's get the NBA. Let's get everyone involved. They could become the sort of go-to news station here for sports. That would be huge. Anyhow, that's my thinking on Twitter. While I'm on Facebook, let's talk about that for a minute. They kind of got a little bit flash crashed. They stopped at 72. I've said that the big risk with all of these companies is that the algorithms and the machines have now cached those levels, and they may try to retest them. That being said, Facebook got to an interesting level today. It filled its gap. It got to the 50-day moving average. There is a little bit more room to sort of the downtrend area, but this was sort of like the real breakdown area. This would be a good place to trim and trail if you're long Facebook. I do believe that if you take a look on the Tuesday retest low, take a look where it stopped, right at the breakout. 82.95 was the breakout. So let's say it stopped at 83. Bingo! Technicals came into play. I believe 83 is a really key level. If you're looking to play for a pullback, put ratios with 83 or below, maybe between 80 and 83 is a good short strike if you're looking to get long cheaper. or if you want to sell some, puts on a pullback down in that area, I think would be a safer area. My big concern with the market in these sort of higher multiple stocks is that the amount of money that investors are willing to pay will come in a lot. So you may experience multiple contraction. That is no fun on high momentum stocks. So just be a little bit careful. We want to use stops. We want to use wide buckets with regard to where we're doing put ratios. We don't want it to be too narrow. Anyway, I've been on here talking for quite a while. I just want to emphasize that there may be some more uproom with regard to the market, but I would be right now I'm really cautious. I've been preaching this strategy all year, and for those of you who have been following me for a while, I'm sorry to repeat this, but we're going smaller position size. We're looking for smaller swings, and we're also looking for shorter time frames. We really want to be on a sort of a now time frame. If you're in options, don't do the monthly so much unless you're looking to buy some premium. If you're looking to short premium, maybe the current week you're in or the one after that is sort of the max. Things can change really, really quickly in a high IV environment. We could take some really good advantage of that when IV is jacked. You take a look. Go into the platform, take a look at use the tools that are there for you. Take a look, at the option stats. Take a look at what the current IV is. Look where the current, IV percentile is. If it's high, look to sell some premium. If it's low, then you're looking to be more of a buyer of premium. It's really that simple. Anyhow, I'm gonna leave you guys with that. I'll pick up a lot more of this into my weekend review video, which will be out on Sunday. Be sure to follow me on Twitter. Yes, I'm going to talk about coal a little bit in the weekend video. Be sure to follow me. My handle is @JustinPulitzer. My YouTube channel is Justin Pulitzer Trades. If you want to rewatch this video, or if you came in between and you want to catch the rest of it, that is great. The rebroadcast on YouTube will also have the links to those articles. Anyhow, let's have a great weekend. Try and decompress a little. It's been a long week, and maybe knock a couple of back. And cheers.